at close yesterday, down 8%.
Yeah, I mean, it got worse as the day went on, of course, and remember, it was up initially, not a lot, but it was up a couple of percent.
At work, I think, and what's been priced into this market,
although,
at the very least.
You know, on 26 numbers, Carl, the thing's trading at about 30 times. I mean, that's 26. That's not, compared to a Palantir, you can't.
Yeah.
You know, in terms of multiples.
People pointed out Jensen's comments were mostly about 25 and not 26.
Yeah.
JP Morgan desk today, the question I keep getting, they say, is why the fade so early yesterday on NVIDIA? What the market needs to get NVIDIA to make a real move is not going to come from Jensen, but rather from other corporates, especially software, since these enterprise use cases are still far off. And it would be nice to have some other companies say, here's how we're going to use it.
Right, here's how we're going to use it. We're going to the world of agentics. We're believers. We're going to see enormous efficiencies. I mean, we expect that will happen. Certainly Mark Benioff, for example, from Salesforce is a key proponent of that and what that's going to mean for many of their customers. You do have Sam Altman saying, we need more GPUs. We can't get them.
That should be bullish, right?
Yeah, it should be bullish. Now, that is one of the key customers here. Not exact, you know, it's the products that they will come up with for the enterprise that Carl's talking about, not necessarily the actual OpenAI and their need for GPUs. But it doesn't hurt when they say we got huge shortages. We got to do something about it. There's the quote from the JPM desk.
I think something else is going on here. Maybe not necessarily related to tech, but I am noticing it more come up in the notes on overall trading and the market sell-off notes, which is that ugly word of stagflation. If we are going to start to see the weakness in the consumer and in the labor market at the same time where there's risk of inflation because of tariffs, and it might not be one-off price shocks if we're going to get this rolling 10% increases on China tariffs, are we going to deal with a backdrop of stagflation, which is just ugly, right? Market doesn't like it. Stock companies don't like it, bad for the economy. Let's talk about all of that, especially with today's numbers in focus. PCE out, another mild number, I would say. Diane Swank, KPMG chief economist, joins us now. Were you relieved to see that inflation number this morning, Diane?
Well, this is exactly what the inflation number was expected to be. We had already the inputs from PPI and the Consumer Price Index, and this is exactly what the Fed expected to see as well. And that's most important, is that we're getting to a point in time where the year-over-year comps get much easier, and the momentum in inflation is going to show some signs of cooling. The question is, can it stay there? And that's what the Fed has also been warning about. We've even seen some Fed presidents hint at being cautious about the lessons of the 1970s, which of course were stagflation. Many of the effects, this is before any of the effects of recent policy changes come into play, and even tariffs take a while to actually be implemented. There is a gap between even the emergency use of tariffs that the president has used and when they actually show up out there, and I think that's important as well. The weakness in consumer spending, we saw that in retail sales, and it was really more due to the fact that we had two massive winter storms in the south, places you don't usually have it, which limited mobility. Store traffic fell along with traffic on dealer lots, and we're going to see that pick up a little bit in February. So it's all way too soon to look at the economic effects of the president's proposals, and the Fed knows that, and that's why they've been so cautious on this. We're comfortable where we are for now.
So are you not reading too much into the weaker economic data and worried about demand actually falling off at the same time? And I know we don't know the effect of the president's policies, but we are getting tariffs from every angle here. And I think another surprising fact for the market has been DOGE, and just the fact that they do seem to be cutting a lot, and especially the federal workforce, and whether that's going to have a negative impact on the economy.
I am very worried about those things. It's just sequencing when they actually hit. In fact, the February employment report will probably not show much effect of the cuts yet. We're not going to see it until the March employment report. And we know the spillover effect of many of those cuts can multiply in the private sector, and it's already having a chilling effect, and starting to see increases in furloughs out there in nonprofits, in the educational sector, in health sector, in terms of exploration research. all of those things have effects down the road, and they're going to start compounding over the course of the year. And I think that's the most important thing. The other issue, and I think it was alluded to in the earlier program, is how much uncertainty we've seen with the rapid pace of shifts and the push to execute with the slate of policies on the administration. The sequencing of the effects are that you're getting many of the negative effects up front, and uncertainty, which acts as its own tax on the economy. There's a lot, I talked to a lot of C-suite individuals, CEOs, CFOs, and HR professionals that are looking at the economy saying, we don't know what to do right now. And that freezing, that sort of hesitation is a tax on the economy in and of itself. And that's something we're very concerned about in terms of economic growth going forward.
Yeah, no, we definitely took note, Diane, of the layoff announcements yesterday from Autodesk and HP and Google, and there have been others in the last few days. The hiring freeze at Stanford announced yesterday. I do wonder, there has been some discussion this week about the break-even for jobs maybe moving into the 75K to 100 range. Where do you think that is right now, and would you be looking for this to result in a negative NFP print this year?
We could easily get a couple of months into the red on ink on the actual payrolls, and I think that's important. I wouldn't even be surprised to see it as early as March, but you're right, the break-evens have fallen mostly because we're also about 1 million people that were asylum seekers are now illegal immigrants in the country. They had been legal. They can no longer work. They're also looking at going after TN visas from Mexico and Canada, making them unable to work. That constrains participation in the labor force and creates these pockets of acute labor shortages where there already are shortages like construction. Think about rebuilding LA after its fires, or in the leisure and hospitality sector, and in the care sector, child care, elder care. That's where a lot of immigrants have filled jobs that were vacant. And remember, much of the Fed's sort of soft landing scenario really was dependent on that surge of immigration that helped balance the labor market and fill all those excess job vacancies we had. Now, the reason people are worried about stagflation is you see it in the consumer confidence numbers. Yep. They're worried about their jobs. At the same time, they're worried about higher inflation.
Yep, well said. Thank you very much, Diane, for joining us on PCE Day. Diane Swan.
Thank you.
When we come back, we'll get the view from China on the president's tariff threat as we get Zelensky at the White House today, maybe get a little more clarity on tariffs after noon. As we wrap up the month of February today, we'll look for some positioning flows, whether that changes. But for now, futures hanging on to the green. We're back in a moment.
up. I want
China speaking out against the president this morning, vowing to retaliate if he does impose that additional 10% tariff on that country's goods next week. Let's get more from Eunice Yoon in Beijing. Eunice, we're getting some comments from Macron in France saying he didn't get much hope on tariffs when he was visiting in the last few days. What is the word from China?
Well, the word from China is that the Chinese government is threatening to take what it described as all necessary measures. So this is unlike earlier this month when China vowed corresponding countermoves to President Trump's February 4th 10% tariffs. So immediately after those tariffs had kicked in, China had come up with its own actions. So these included counter tariffs, export curbs on critical minerals, a blacklisting, as well as flagging a probe into individual U.S. companies. And these were seen as relatively mild, but that they sent a message of what Beijing could do. So investors here today dropped stocks. They were worried about the potential for escalation of tensions. The research house ANZ had said that with the March tariffs, the average U.S. tariff on Chinese goods could reach 33%. So it expects a hit to Chinese GDP. Now, the timing of these tariffs would also be quite interesting because they'd be coming in one day before President Xi Jinping heads into one of the biggest political gatherings of the year in this country, the National People's Congress. This is a time when the Beijing leadership unveils what the economic blueprint for the year is going to be. So there is very likely going to be many investors looking to see if there's going to be more mention of stimulus.
Is there any indication, Eunice, that there's going to be talks or a deal? For instance, that's what's happening with Mexico and with Canada. First of all, what the Trump administration wants and how much China is willing to do to get there.
Well, President Xi is in a different position than the Canadians and the Mexicans because of the nature of the relationship with the U.S. and China is much more adversarial. So President Xi isn't going to want to appear as though he's bending to American pressure. So that's one point. What also I think is interesting is that in the commentary, unlike Mexico and Canada, China didn't indicate at all as to whether or not they would address what appears to be motivating President Trump for these tariffs, and that is the fentanyl trade. So today, the Chinese said that this was just passing the buck, but it looks unlikely that he would necessarily pick up the phone and call President Trump to be able to work this out. In fact, a lot of the discussion here is that he's probably going to, or at least the Chinese would wait it out and then hope for some larger deal. That's something that they would benefit from.
Eunice, has anyone there from the government made mention of the fact that China stocks for the year to date are up 18% and the S&P's red?
Oh, a lot of people have been talking about the stocks and the Chinese stocks and how exciting it is. And a lot of that is driven because of the interest in tech. So it's just that every day when you look at state media, there seems to be either an announcement of a Chinese tech company coming up with some sort of chat bot or talking about their AI or integrating DeepSeek, or it's the pumping up from state media and patting their backs that the Chinese are doing so well in this area.
Eunice, thanks. We'll see what happens certainly over the weekend and next week. Going to be an important one. Eunice Yoon in Beijing. Take another look here at the pre-market as we continue to monitor whether or not this momentum trade can hang on, especially given the fact that the last, I think, 5 Fridays have been red. We'll dive into Dell and certainly Autodesk as well when Squawk on the Street continues.
Expecting reversal to upside. RTH opens in 1 minute. New tick high. Seller exhaustion. New tick high. NQ overnight low crossed. Sell sweep.
Big
Sellers
seller
absorbed.
440 contracts. Big seller 162 contracts. Big seller
exhaustion.
110 contracts. Big seller 125 contracts.
Sell
Big
sweep.
buyer 103 contracts.
New tick low. 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 Overnight low crossed. Buyer exhaustion. New tick high. New tick high. New tick high. Buyer exhaustion. Buyers absorbed. Seller exhaustion. New tick low. New tick low.
Big buyer 100 for contracts.
New tick low. New tick low.
Big buyer 117 contracts. Big buyer 131 contracts. Big seller 105 contracts. Big seller 124 contracts.
New tick low. New tick low. New tick low.
Big buyer 100 contracts. Big buyer 100 contracts. Big buyer 150 contracts.
buyer exhaustion.
Big buyer 121 contracts.
Iceberg.
from Wall Street, this one really stood out to me. So the newly confirmed, newly minted Commerce Secretary Howard Lutnick, in an interview this week, was asked about companies warning about tariffs, and here's what he said. Wall Street companies look at one at a time, right? If I'm importing goods and I have a tariff on me, how's that going to work for my shareholders? Wall Street analysts don't look at America writ large, American people writ large. Donald Trump was elected by a majority of Americans to take care of America. And if that doesn't work out for your particular company, I'm sorry. And the reason I highlighted this is because there is this view out there that maybe there's a Trump put, David. Maybe there's a pain threshold. The president doesn't want to see the markets crater. President doesn't want to see companies get hurt.
New tick high.
But I do think that this was notable from Secretary Lutnick that, you know, he's thinking about Americans writ large, not necessarily about the S&P 500.
Well, you've also made the point that it's not clear that it is going to be inflationary, or at least if it even was, it would be one-time in nature, but it could impact demand, which obviously also impacts the overall economy.
Sure, and that's one of the things.
We're talking broadly about tariffs now.
And I think that's what the bond market's telling you, right? If the bond market was worried about inflation, you'd see higher yields. Bond market may be worried about stagflation or lower growth coming from all of this, which is why you're seeing lower yields and why the equity market is not responding positively to it. We've seen periods where the equity market likes these lower yields, right? It's stimulative. It's better to have lower mortgage rates. But instead, equity market, and mainly tech stocks really, are giving a thumbs down, and that feeds into whether we have, you know, bigger risks of a slowdown in the economy while inflation stays a little elevated.
Speaking of tech, been a tough month for the broader markets. Tech's coming off the worst day since January. S&P, NASDAQ on pace for their worst week since September. All three major indices firmly in the red on the month. Our senior markets commentator Mike Santoli is here to break it down. I love this stat out of Bespoke on the NDX. Month to date, down 6, is not far from what the NDX did the month COVID broke.
That is true. Yeah, I mean, there's a little bit of calendar stuff. I think they also said it's the fastest 5% drop in the NDX over this shorter period of time since September 2020, which is interesting because that was a very sharp, sudden, swift correction in an otherwise uptrending market. Things have gotten really overheated into Labor Day after that initial 2020 rally. Yeah, there's no doubt that it's been this erratic action back and forth, and we've kind of on a net basis lost value in the indexes. On some level, not all of it should have been unexpected if you stack up what the conditions were at the start of the year. Hyper-concentrated market, high expectations both for growth and policy levers to kind of work in favor of markets. We knew that the beginning of post-election years tend to be weak. We knew that after two back-to-back 20% up years in the S&P, you usually can't expect it. So in other words, being flat at the end of February doesn't really disqualify this market as just being kind of in a routine consolidation zone. I do think the issue, though, and Sarah gets to your point, which is the market can usually deal with kind of one thing going less than right. But you do have this kind of slow motion growth scare, deceleration story, along with this stampede out of high value, high momentum tech, high expectation tech. And that's been a little bit too much. A broader market, I always say this, is not a stronger or more stable market. If you don't have the anchor of the big seven, which are a third of the index, sometimes things just get dropped along the way, and you have a little more of a higher volatility backdrop.
Even when you talk about high momentum or you know, tech, I mean, even within some of the big names, there's a differentiation, or those that have moved so much that are a part of that cohort in multiples. I mean, you know, I can pick out a name for you that's trading at 20 times. And by the way, then the backdrop is we've seen no diminution in spending that would seem to at least confirm the fears of so many investors.
That's right. No, you haven't seen it. What you've seen is the market unwilling to pay today for assumptions that multiple years are going to be just as strong.
Right.
I was looking back at Apple's valuation in the immediate post-iPhone boom years. They had a similar trajectory of NVIDIA's like doubling revenue and earnings 2 years in a row. It's stepping down to 50% this year, stepping down to 25% next year. Almost unprecedented amount of incremental growth on this big a base.
Yes.
Apple had a similar situation. The multiple was compressed constantly. It went to like 10 times earnings because the market was unwilling to say a hardware company is going to kind of get all these cycles right. Eventually, the market
net volume high.
It became a services business. It's now the most defensive Mag 7 company. So anyway, something like that's happening when it comes to NVIDIA, at least.
Interesting. So
Expecting
you could
reversal
expect the
to
multiple might
downside.
continue to compress, and/or even if the company continues to perform at levels that are
Yeah,
expected.
I don't know if
beyond
it's going to go the same way.
Buyer
the overall
exhaustion.
market's
Big
more
buyer
expensive
333
now, so, maybe it
contracts.
sort of just goes closer to the market multiple, or just you can just understand why it is. Also, I think we're at a time where they better start talking about what they're going to do with the free cash flow. Right now, next
Net
year's
volume
supposed to be $100
high.
billion free cash flow. They don't need it. They don't spend a lot on capital. So it's kind of an interesting situation, just on its own in terms of NVIDIA. And the rest of the market, I do think, is just dealing with, can the banks rescue the market? Meaning the stock's up right today,
And if
up
it really
1%.
is a growth scare in a stagflationary environment, why would the banks be
That's
robbing?
right. That's right. I wouldn't say it's stagflationary. I would say it's, decelerate. And, the other piece of it is, to the extent that you came into this year with one of your top 3 talking points was outbreak of animal spirits by businesses, by investors, everybody's going to grab for risk. That has been complicated by the policy noise. No, and it's totally plausible that it could happen. But the policy noise and the fact that we have all these deadlines and these uncertain effects, I think is getting in the way of that piece of it, if nothing else. But yeah, banks are doing great. The thing is, if you wanted to bet on an economic acceleration or comeback, you're buying European banks. You're buying Hong Kong. Right now, it doesn't seem like it's the high leverage play to buy U.S. industrials, which have outperformed for 2 years going into this phase.
I would add, when it comes to animal spirits and uncertainty, certainly we're seeing that reflected as well in the dearth of deals. For example, M&A, which again we expected would be going gangbusters, perhaps even by now. Doesn't mean it won't for the rest of the year. Mike, thank you. Let's turn to Washington now. Ukrainian President Zelensky is set to meet with President Trump. That's about an hour from now. Eamon Javers is at the White House. What are we expecting, Eamon?
David, enormously high stakes here at the White House today for Ukraine, for the European economy more broadly, for the future of the U.S.-Russia relationship, as Volodymyr Zelensky is expected here at the White House today at about 11 a.m. He's going to meet with President Trump. The president has been pushing the Ukrainians for a deal on minerals. He wants the United States to be reimbursed financially in some way for the military aid that it has given to Ukraine over the past several years of the Ukraine-Russian war. Here's what the president had to say yesterday about that deal.
The minerals agreement will provide the basis for a more sustainable future relationship between the United States and Ukraine, and thus stimulate the long-term prosperity that will help the Ukrainians rebuild their country.
Now, Treasury Secretary Scott Bessent said yesterday that this deal is done. One of the questions we have, though, are what are the details of the deal? We've been talking to a number of sources behind the scenes here through the morning, trying to peel out some of the actual specifics of what this agreement is going to say between the United States and Ukraine when they sign it later on this morning. Don't have all those specifics for you. One question that I would raise, though, David, is you heard the president yesterday talking about minerals. One of the questions here is what does this imply
NQ
for the rest
overnight
of the
high
Ukrainian
crossed.
economy? What about other Ukrainian infrastructure, such as ports, pipelines, oil and gas? Are any of those details
Net volume
included in
high.
this agreement as well? What percentage ownership of the revenues of
Net
those
volume
industries
high.
does the United States get as part of this deal? How much money will be turned over to the U.S. Treasury in future years? I can tell you that the White House views this as a significant stepping
Net
stone
volume
to the
high.
U.S.-Ukrainian relationship and a pivot to the future of the U.S. approach to Europe. They're very bullish on this deal here at the White House this morning. I can tell you what's actually in it, though, still working on that, David.
I think another thing that could be a win here is that it's a counter to China, because China controls a lot of the world's rare earth
Net volume
mineral
high.
deposits and a lot of these really important commodities. My question, Eamon, is what does Ukraine get? Is there a promise of more aid, military aid, to fight this war with Russia?
Yeah, I mean, the implication is, that there will be no more U.S. military aid if Zelensky doesn't sign this deal. So in that sense, Zelensky would be signing a deal here really under duress, right, of an existential threat to his country, and the United States holding that aid over his head and saying, you better turn over the mineral rights or else no more military aid. The question is, in the agreement that we see later today, if we do see the terms of it, will there be a specific commitment from the U.S. side to military aid in exchange for minerals? And then the other big question that came up yesterday in the meeting with the UK Prime Minister Keir Starmer, who was here, is will there be a U.S. guarantee, security guarantee for any peacekeeping troops that are put into Ukraine to
New
separate the
Ticlo.
warring parties. That is, if
New
say,
Ticlo.
British and French troops go in as peacekeepers in Ukraine, will the United States guarantee their defense if they're attacked by Russian forces or not? That could be a big hinge point on whether the Europeans are willing to put in troops, whether they're backstopped by the United States or not. All of that, Sarah, still in negotiations apparently at this hour. We're trying to work on some of these details here. We'll get them to you as soon as we can.
All right, it's been a big week of foreign leaders at the White House.
New
Eamon, thank you
Ticlo.
very much.
You bet.
As we head to break, here's our roadmap for the rest of the hour. Nvidia trading in bear market territory. Tesla tanking 30% this month, but Apple looking like a safe haven. How to navigate the tech trade right now.
Plus, we are counting down to those tariff deadlines. We're going to discuss what's at stake for the automakers.
And the health of housing, a lot of weak data out recently. What that might mean as the spring selling season gets a little bit closer as Squawk on the Street continues.
Got eyelid itching, crusties, and swelling that won't go away? It could be
Demodex blepharitis, and we're Demodex mites. We're very common and super irritating to your eyelids, but we love making ourselves comfortable here. Oh yeah, steam time!
if Demodex mites are partying it up on your eyelids, it's time to eliminate the root of the problem with Xdemvy. With one drop in each eye twice a day, you can kill the mites in just 6 weeks. Xdemvy is the first and only FDA-approved treatment that kills the mites that cause Demodex blepharitis, a common eyelid disease. Avoid touching the tip of the bottle to your eye or other surfaces to minimize contamination. Wait 15 minutes before inserting contact lenses. In clinical trials, the most common side effects were stinging and burning in 1 out of 10 patients.
Party's over, folks.
It's not you, it's Demodex mites. Talk to your eye doctor today.
Some people took DeepSeek to mean actually that you need less compute.
From a demand perspective, DeepSeek was fantastic. It open sourced a reasoning model that's absolutely world-class. AI has become better.
If you believe every customer experience is going to be reinvented by generative AI, then you're going to be building a lot of generative AI apps.
Even if you say AI, I don't think this will be deflationary in the short run. It may very well be deflationary, after 3 or 4 years, but most of us for now are spending more money on it, not less.
As a contractor, I find sometimes the
Net volume high. 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 Overnight high crossed.
Big seller 958 contracts. Big seller 117 contracts.
By sweep. Net volume high. Net volume high. Net volume high. Expecting reversal to downside. Net volume high. Net volume high. It's 10:30 a.m.
Big buyer 119 contracts.
ESRTH 500K volume reached. ESIBH crossed. ES expected move hit. Net volume high. 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 Net volume high.
Big seller 594 contracts.
Net volume high. 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 Net volume high.